Hey everyone, I've been getting a lot of questions about ZIM, Integrated Shipping Services Company. Of course, shipping has experienced a volatile time since the pandemic onset, so I thought I'd make this brief video providing an overview of what's going on with ZIM stock. So let's get right into it, getting the details straight from ZIM CEO. So let's look at these details here. So in the first quarter of 2023, the company continued to experience a download pressure on freight rates that began in the summer of 2022. Remember, during the pandemic, freight rates, right, shipping rates exploded higher. Companies were tripping over themselves to secure shipping on cargo ships to bring their inventory over from trans-Pacific areas into the US, and that created an increase in shipping rates. That's now reversed because companies have too much inventory. They're no longer ordering inventory, and that's creating a significant decrease in shipping rates, and that's what ZIM is experiencing right now. So that created a situation where the company experienced an EBIT loss of 14 million. EBIT is earnings before interest and taxes. And on that metric, the company lost 14 million. However, it did generate cash flow from operations of 174 million, and ZIM does have 4.2 billion dollars in cash. So it's not in any sort of dangerous position because it does have very strong balance sheet, and it did generate positive cash flow from operations to the tune of 174 million in its most recent quarter. That said, the company does continue to anticipate the pressure on rates to continue in the future before we see a more durable rate improvement in the second half of 2023. And I would say, looking at all of the retailers and companies that I follow, this would appear to be an optimistic forecast because many of the companies that I follow still have too much inventory. I mean, you could go yourself, look at Walmart, Target, Home Depot, Nike, all across the board. You look at all of these retailers that primarily focused in the US, they've got way too much inventory. They'd prefer to work through their existing inventory and only order and import the most freshest required inventory that they need. So I would say this is an optimistic outlook if they're expecting things to improve in the second half of 2023. So fortunately, ZIM understood that during the highly lucrative market period in the last 2 years, that a more normalized operation environment was on the horizon. That's good news, right? It wasn't like management said, "Oh, the boom times are here forever." Unlike one company, remember Peloton? Remember what they did? They thought that the boom times during the pandemic would last forever. They invested in expansion, and when gyms reopened, their business collapsed. So fortunately, ZIM did not make that same mistake. They planned for an eventual normalization, and they remain cautious in their cash allocation decisions. So while they expect the number of vessels they operate to remain stable, their operated capacity will grow because they're going to invest in bigger ships, and their number of ships will remain stable, but they'll have bigger ships in operation. So under that planned growth in operating capacity, the fleet will be better suited for our trade and services. So they expect their cost per TEU to decline as we replace smaller vessels with larger ones. So if their business returns to normal, their profitability should expand because their cost per TEU is declining because they have larger ships in operation. Additionally, they're the first liner to operate LNG vessels on the Asia to East Coast trade, and supporting our customers in the ESG journey is a high priority for us. This could help ZIM lock in clients that are focused on ESG, and being the first one to operate this could secure them some business that otherwise may go to other clients. And so the big takeaway here from ZIM and what's going on with ZIM is, yes, they did experience boom times during the early parts of the pandemic, but that wasn't expected to last forever, and now they are experiencing the turnaround, right? The flip side of the boom times. Right now, it's the opposite. Freight rates are extremely low, and they're getting less shipping cargo. But the good thing is that management planned for that. They were aware this was going to happen, so the company wasn't caught off guard, and they're not going to be in a terrible situation. The near term will remain pressured. Their revenue and profits will remain pressured, but they have the cash and they've restrained their spending enough so that they can make it through this tough time and make it to the other side when the shipping services industry will normalize eventually to where it was, closer to the pre-pandemic rates. All right, but that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.